Hi, everyone, and welcome to this edition of Best Ed. We're here to discuss the latest global economic updates. I'll start off with the U.S. Milton, as we all know, the U.S. is dealing with significant inflation right now, which has turned into a state of stagflation. Can you explain what stagflation is and what the Fed is doing to address it?
Well, stagflation is not a technical term. It's a journalistic term. Recession is actually very thoroughly defined by the National Bureau of Economic Research. And if you have trouble sleeping, you can get some of their papers. They'll help. It's colloquially defined as 2 consecutive quarters of negative growth. But that's not the technical definition. Stagflation is simply the combination of 2 words: stagnation or decline or recession and inflation. And just let me take a moment. It was born in the 1970s. In the 70s, there was this belief that if you got inflation when the economy was roaring, when there was full employment, and when all resources were utilized, there would be a supply constraint, and you'd have inflation. And the way to fight inflation was to just ease some of the heat out of the economy. And they tried that, and it didn't work. Because what happened, and this is one of the reasons why I think there might be stagflation now, in fact, I'm almost very confident of it, is that people got expectations of inflation. And the expectations meant that when workers went to negotiate, whether they were unionized or individuals, they said, look, the cost of living is up 8%, 7%, it's going to continue up. Give me the raise. And the boss, confident that he or she could raise prices to compensate the bottom line, said, sure. And so the inflation gets a life of its own. So now it no longer matters how you're affecting the economy. If you take the heat out of the economy, it does not take the heat out of inflation. And that's why this situation is so dangerous.
Can you maybe take us through a little bit of what those contributing factors said? How'd we end up here?
Well, the president has blamed Vladimir Putin for the inflation. It is partially, well, I wouldn't say it's Putin's fault. It's the geopolitical situation's fault. There's a shortage of oil because Russia pumps about 10% of the global supply of oil, and no one's buying it anymore because no one knows how it's going to get to market. So there's a shortage of oil, And so it's just to a small extent, his blaming Putin as a shorthand is reasonable. We also have supply constraints because we came out of the pandemic. The economy was roaring out of the pandemic. The first quarter was a little different, but the economy was roaring out of the pandemic. People had shut down supply sources. They had shut down factories. They had shut down shipping channels. And so there was a scramble to keep up. That's the popular way. But I think the inflation has much longer, deeper roots than that. And that's why I talk about stagflation. Since 2008, the financial crisis of 08-09, and the Great Recession that followed it, the United States, the government has been pouring money into the economy, either through tax cuts with Trump or spending with Obama and then Biden. And that's bad for inflation. But what is even worse is the Federal Reserve has financed that flood of federal money. The deficit widens, and the Federal Reserve, instead of they're borrowing money, but the Federal Reserve is buying all the debt. The Federal Reserve, and then this number is not in front of me, so if there's a fact checker here and I'm off a little bit, you'll forgive me. The Federal Reserve, in the 10 years following the Great Recession, bought $8 trillion in new federal debt. So effectively, they printed money to buy the debt. $3 trillion in just the last couple of years. So effectively, what they were doing is, we don't run printing presses anymore, but it's the digital equivalent. That is the classic prescription for inflation. And this has been built into the economy for a long time. We can, if you're interested, we can discuss why it has been delayed. But it's here, and this is a fundamental root. Now, the president, for his reasons, does not want to point to that. He did one thing to contribute to this situation, aside from continuing to spend the way all his predecessors have, and that is he shut off the supply of domestic oil. He closed down the Keystone XL pipeline. His energy department is making it very difficult to drill, and his attitude, of course, is discouraging the fossil fuel industry. Now, this may be the price we're willing to pay for the climate change situation, but nonetheless, this is contributing to the inflation as well. Aren't you sorry you asked?
Well, going into another hot topic around what the media and financial community are saying, everyone is now talking about a recession. What are your thoughts on this? If it happens, when is it likely to happen?
Well, let me say, first of all, we had a negative first quarter GDP, and I do not think that is the recession. I think we are going into recession. And in fact, as economics goes, economic forecasting goes, there are fewer things I think that are more certain than we will go into inflation. And to answer your last question first, about 12 to 18 months, not this first quarter. We will have positive numbers in the spring and summer, at least. But we have two situations here. The Federal Reserve is pushing up interest rates and restraining credit. That is the classic way to deal with inflation. It's particularly hard because there are these inflation expectations, and the Federal Reserve has just begun. They've raised rates. Now we have an overnight rate, the federal funds rate of 1%. We are very little off the floor. The Fed has stopped pouring money into the economy, but they have to do a lot more. The more they do, the more that is necessary to fight the inflation, the more they constrain the economy, and the more they will precipitate a recession. But even if the Fed fails in its job to fight the inflation, even if it says, well, and Jerome Powell is not the bravest man in the world. If Jerome Powell says, I don't want to do this, I'm afraid of creating a recession, we'll still have a recession because the inflation itself distorts the economy and would create a recession. The 12 to 18 months, the near term is if the Fed acts. And it would be a shallow, shorter recession. If we let the inflation do it, it'll take longer, and it will be more severe and take longer to come out of. So I see the recession as foregone. Now that's easy because there are always recessions. So the statistics are on my side, but in this case, I think the situation is pointing that way.
What else could the Fed be doing to prevent or at least minimize the severity of this upcoming recession?
I think the Fed could act more forcefully than it has. And it has to just recognize they are going to create economic weakness. It is the only way to fight this, and it's going to be a hard fight because of the inflation expectations. If they don't, then we'll have more economic distortions. So as much as I don't want interest rates to rise that much, and I don't want the economy to falter, I think the Fed has to act forcefully. Otherwise, the situation will be worse. And I think that's what they have to do. It is unfortunate that the Federal Reserve and the Treasury and the President pretended there wasn't inflation for 12 to 18 months when we had it. Because that might have, if they'd acted forcefully at the beginning, that might have thwarted this development of inflation expectations. We would still have a problem because this has a long history, but it would be much more manageable. But instead they pretended it didn't exist.
Another thing we've been reading a lot about is this Great Resignation. Is there any tie-in or impact that's having on inflation or just the general economy right now?
It is. We have part of the reason the economy is having trouble growing is because there are more jobs than there are people who want jobs. And if you want to think in terms of that's for the growth. In the inflation side, inflation is at base. It's more complicated in its details, but at base, it's money chasing goods. If you have more people working, they produce more, and that tends to ease the inflation. The reasons for the Great Resignation are complex, and a lot of them are demographics, so we don't overcome them too easily. But if more people went to work, it would help with the inflation and help with the economy. So you're all doing your patriotic duty here.
Let's move into the global economy before we open up the floor to questions. What about the economy of the EU? Is there inflation there as well? And if so, what are they doing about it?
There is inflation in Europe, a little less than the United States. The latest number, the one we got yesterday, said 8.3% for the last 12 months. I think the latest number for the Eurozone is 7.5%. So it's a little less, but it's hardly pleasant. Christine Lagarde, who is the president of the European Central Bank, has not just recently stood up and said, this is a grave situation, we're going to do nothing. She said her excuses are, because she was asked at the press conference, why the Americans are doing something, why aren't you doing it? And she said, well, Europe is behind the United States in the recovery from the pandemic. And she said Europe is more vulnerable to the sanctions on Russia, particularly the energy part of it. And I can't dispute that. Both are true. But she's not helping the inflation situation in Europe by not acting. In fact, she's doing exactly what I just blamed the Fed and the White House and the Treasury for doing here. But what she's doing is because in this respect, everyone has been playing the same game, running huge deficits, at least in the developed world, and financing it with central bank created money. What she's doing is she's making Powell's job more difficult, because as rates rise in the United States, money will flow from Europe to America, and he'll have to absorb that liquidity to fight the inflation. And he will be making her job easier, because as the money flows to the United States, she is under less pressure.
Interesting.
Now, she may be doing this intentionally. She is very political and not stupid.
One last question from me. There's been a lot of speculation that the Chinese yuan is going to overtake the dollar as reserve currency. Is there any truth to that?
No.
Firm answer. A little explanation for us.
A little boilerplate. It's popular. Well, the media likes sensationalism, as you people know. You're in the business. And they want to say the dollar is declining, and the dollar is not what it was. The United States economy, on a relative basis, is far from what it was when the dollar first took the role as the premier reserve currency in the world. And China has an economy that might be able to do that. There were some complications there, but the most important thing is the Chinese control their financial markets completely. And in order to be the reserve currency, the currency with which people trade, the currency that backs up most imports and exports in the world, you have to have open financial markets. If you think of yourself, whether you're an importer, an exporter, or a finance professional who has to deal with these trades, you want to be able to come in and out of currency 24/7 at a moment's notice. China controls these things, so you can't in China. The other thing is that, and this is where the United States and to some extent the Europeans could replace us, except for other issues, we have very well-developed financial markets. So if you're trading, if the dollar is, or your currency is the medium of exchange, you have to put money away. You have to hold it, and you want to have a wide array of investment choices. China does not have that. So there are other problems with China, but they are not overtaking the dollar. One other thing. There's a lot of habit and custom involved in the reserve currency. The United States the dollar has been established now since at least the end of the Second World War, and actually before that it was making inroads on sterling, which was the reserve currency. About 80% of the import and export contracts in the world are written in dollars, whether an American is a part of it or not. This is the currency. It's interesting, if you read the Financial Times, and they will tell you how much, and they're talking about China, they will talk about the Yuan value of some event. Then they will tell you what it is in pounds, because they're a British publication, and then they'll tell you about it in dollars, because that is the reserve currency. Those habits change only very slowly. I'm not going to give you a big history lesson, but when the United States was rising between the two world wars as a major financial, economic, and military power, well, not military yet, power. The dollar was making inroads on sterling, which was weakened by the great debt of the First World War in Britain. It took 30 years before the dollar was even with sterling, even though it had all the elements in place by the 1920s. So these habits die hard. So it says to me, A, the Chinese don't have a financial system that can support it. B, it'll take a long time. You're younger than I am. I don't think I will live to see the end of this situation. I'll be 75 later in the month, in case you're trying to get a perspective on that.
Well, thank you. Let's open up the floor to questions. Does anyone have a question for Milton, either virtually or in the room? Dan?
Firstly, thank you, Milton, as always, for your excellent perspective. Obviously, you laid out two possible scenarios for a Fed or inflation busting triggering of a recession. One light, one slightly more egregious. Could you expound a little bit on the impacts of the markets? We sit in the financial markets. We have been in through a period that the economists recently called the everything rally, where typically sort of counter-cyclical or inversely correlated areas of the financial market all seem to be going up at the same time. Feels like we might be going into the everything slump, where there's no safe haven, equities, bonds, crypto certainly not right now, isn't showing up as that digital gold that we all kind of hoped it might be. So what might be the best, worst, middle case for the financial markets as a result of this recession?
This is a great question because it brings me back to this why one would be more severe than the other. Dan's asking that there are two possible, saying the recession is inevitable, there were two causes, and what will this do to the markets? And I think we are moving into an environment, not in everything is doing badly kind of environment, but if the Fed is raising rates, and they are, and we've seen this in the last few months, bonds have taken a terrible beating, and they will continue to take a beating. Let me give you an idea of how severe this can get and why it can precipitate a recession. Right now, you get paid 1% for investing money overnight, 1% annual rate. Inflation is running at somewhere between 8 and 8.5%. Now, what that means is that the borrower pays back the lender in dollars that are worth, in real terms, 8 to 8.5% less. He pays the lender for the use of the money 1% a year. Effectively, the lender is paying him, in real terms, 7 to 7.5% a year to use his money or her money. So the Fed, in order to slow this down, has to raise rates above the rate of inflation. That's a long way to go, and it's going to constrain markets. So the bond market is, from my point of view, to be bold, a debt issue. It's going to suffer. If yields rise, that means stock valuations fall. Not necessarily the price, but the valuation falls because stocks are priced relative to bonds. The price-earnings ratio is really just the yield inverted. Earnings-price ratio is effectively setting your annual earnings as a percent of the price, so it's easy to compare to bonds. The more bonds offer in terms as rates go up, the more pressure there is on stocks. And that creates a slowdown in the economy, which hurts profits, so you get the stock market down. Real estate and gold and maybe crypto, if it could get its act together, would be, and that there's a long tail that hangs on that, they might survive in this environment because they are like commodities, not only gold, zinc, copper, all these things are in short supply, and even in a recession they might, and even in a recession with inflation expectations, their prices tend to keep up. But stocks and bonds, the classic investment vehicles, suffer immediately from the Fed. If the Fed holds back, they will suffer less in the interim, but then we get all sorts of economic distortions. One in particular is that as people see this inflation and worry about these markets, and they don't do as well as inflation, they start moving toward real things. That's why real estate and commodities do better. And that not only distorts pricing, takes away from stocks and bonds in the direction of commodities and real estate, but it also denies the business sector the money it uses to invest for productive activities, and that hurts the economy worse. So it becomes a delayed but a worse recession.
Gabby?
Thanks so much for being here, Milton. This might not be something you could specifically answer, but something I think some of us have been working on, kind of the war in Ukraine, and knowing that Russia and Ukraine are giant wheat exporters, and that there is an anticipated possible food shortage or wheat shortage, just specifically for like the Middle East region. Do you think that any sort of food like shortage could have an impact on the global economy in the future?
The food shortage? Yeah. Well, we have two shortages coming out of Russia and the Ukraine. The Ukraine, of course, is a great grain producer, and they're not producing a lot of grain right now. And the Russians can't get their stuff out. They don't have any trouble growing it, but they can't get their stuff out because of and the Russians are also a major producer of fertilizer. So that areas of the world, and there was a fertilizer shortage even before this situation. So even people who think they can grow it themselves might have trouble. So yes, this is a shortage. Now this is going to come back to commodities. This benefits countries like Canada, the United States, and Australia. I'm sure the average American farmer is delighted that the Russian grain can't come to market. He'll get much more for his stuff, or she will get much more for her stuff, or whatever your pronoun is will get more for your stuff. Got to be careful. I don't think it's going to. I think it's just it's going to continue the inflation, and it's going to exaggerate the distortions I spoke of earlier. I mean, I talked about real estate. It's not just housing. Farmland tends to be very attractive in an environment like this, and with the inflation lodged in food prices, it absorbs more of the investment resources of the economy.
Brandon?
So you described some of the political factors that are contributing to the economic situation that we're in right now, which I think from a layperson's perspective is quite frustrating to hear, because it feels like it could be avoided if people weren't treating this, monetary policy as like political football. Do you think it's feasible to have, theoretically, could there be a computer program or something that dictates what the optimal monetary policy should be, given a market environment, given dollar price? Is that something that could manage the economy more responsibly so we don't get these large spikes in all of our grocery bills or our rent prices? Or is that just pipe dream? There's way too many factors to account for.
The question is, could we depoliticize monetary policy and therefore have a more steady course and avoid some of these spikes, both in inflation and then the recession that comes as a result? Some economists have said, and we've had some central bankers who want to do this. His name escapes me now, a Dutchman who was the first president of the European Central Bank, and his name escapes me. My apologies to him if he's listening. He wanted to say, look, the economy has a natural rate of growth. Each economy is different, has a natural rate of growth. We shouldn't increase money. We shouldn't increase the financial resources of the economy any faster than that rate of growth, or any slower. Slower would constrain the economy, faster creates the inflation. And he wanted to set up a kind of a rule like that. Of course, the politicians who really have all the power, they don't want that. They want this handmaiden at their disposal. I'm not singling out Joe Biden or his team when I say this, but he had a political interest in saying of the inflation, nothing to see here, move along, and then say to the Fed, you keep pouring money on the economy, you keep interest rates low because I want to make a big show. Because there's an election in 2022, not for him, but for his party. Now, it hasn't worked out, but I can see exactly what they were thinking. Now, they don't confide in me, but it seems obvious to me. And so it's not a pipe dream from a technical point of view. I actually would endorse that sort of approach. But it is a pipe dream from a practical point of view because the people with power would never tolerate that. They might vote for it. They might say, yes, let's institute a rule. And then as soon as something happened, they'd say, well, the situation is dire and we have to deviate from the rule.
Thank you.
You're alone, Dan.
Dan, welcome.
I wanted to make sure no one else wanted to ask a question before I asked another one. Could you pause some, as a financial historian or a kind of sort of amateur financial historian, I'd love it if you could chat a little bit about the finger pointing that is going on with regards to inflation at corporations. I'm thinking particularly about previous administrations, the Nixon administration, the Carter administration, to try and force price controls, blame big corporations. I think for the uninitiated, perhaps if you haven't seen this in history, the inflation is due to price gouging argument is a very compelling one until you look historically at attempts to manually control prices and how futile they've been. Nixon had a program, Carter had a program, they all failed. And only through studying history do you realize how much of this is a monetary issue, really, and an expectation issue, as you said. But I understand that we will have people here who, and you see it on the news every day, it's very tempting to sort of say, well, if only Purina or Coca-Cola would stop gouging on prices.
Well, the question is that there's a lot of accusations now, and has been every time we've had inflation, that the cause is corporate greed and price gouging, and they're the ones who are raising prices. And if we would just control them, either by putting in price controls or bullying them, then we could avoid the inflation. And that has come and gone for a long time. You forgive me, I'm old, but I'm not old enough to remember this. In the Roman Empire, there was an inflation, and I think the emperor was Diocletian, but don't quote me on that. And the reason I know this is because when I started in this business, there was a lot of inflation, and we had President Nixon and then President Carter and President Ford all try price controls of one form or another, and they all failed. And what Washington said when they put in the price controls is they failed because, yes, business is gouging. They will take what they can get. That's their business. But they can't. If they can't get it, they won't take it. So it's got to be at a more fundamental level than just, you can point and say, look, you raised the prices 8%. And he says, well, my costs were up 8%. And both are true. But anyway, in the Roman Empire, the argument was, at the time, well, we are not punishing them enough. We've put on price controls, but they're violating it. And we need price controls with teeth. Well, evidently the Emperor Diocletian put on price controls and said, if you violate these, the punishment is death. By crucifixion, actually, which is not a pleasant way to go. And the article I read, because I wasn't there, said, now these are controls with teeth. They failed. So the price controls don't work. They also distort things. And I'll give you an example from President Jimmy Carter, when we had so much pressure on oil prices. The original embargoes, there was a shortage of oil, the prices were going up. And he said, well, we're going to put on price controls. We're not going to let you raise prices. But then demand goes up because it's cheap, or cheaper than anything else. So he said, we're going to have to ration because that's the answer. And what he did is this went in place in the spring. And he said, we will deliver oil no higher than you got last year, which seems like a reasonable benchmark. Except we were going into the summer driving season, and no one could drive because it was too expensive. So they stayed home. So the in rural and resort areas, there was a glut of oil. And in the cities, there was a tremendous shortage of oil. Now, the prices would have fixed that, but the price control people didn't, and the rationers didn't. So they all fail. They fail not because they fail because they're silly and they distort the economy, but they also fail, as you pointed out in your question, Dan. The root is monetary, and the business people are just charging what the market will bear. And if you print a lot of money or digital money, and and it's easy to raise prices, sure they will. And politically, it's very good, especially if you're on the Democratic side, because you don't feel beholden to business to say, oh, these ugly people, and you can get votes that way, but it's not going to solve the problem.
I believe, Olivia, do you still have a question?
Yes, I was just thinking yesterday, the House just passed the $40 billion aid bill to Ukraine, and now it's expected to go through the Senate. And I just would love to hear your thoughts on that, how it could have potential impacts on inflation, and how that will affect the economy.
The question is about the bill that Congress just passed to aid Ukraine, and will it have an effect on inflation? Well, it widens the deficit, so it doesn't solve that problem, and it puts more pressure on the Federal Reserve. The amount of this, it may matter to the Ukraine, and it may matter to the Russians fighting there, but it's a small issue, but it just adds to the problem.
Thanks, Sam.
So obviously there's like a massive dependence on oil in the economy, but at the same time, obviously like a lot of more interest in ESG investments and divesting from fossil fuel industry in general. So like realistically, how close are we to shifting, or like how can we shift the economy from that reliant dependence on oil?
The question is oil is a problem in this environment, and there's still great dependence, and how quickly can we shift away? Not very, unfortunately. The alternatives that we're touting now are either not reliable enough or very expensive to build. So right now it is the only reliable energy source. And the Europeans, who were further along in this project, the climate change project, than we were, are paying a dear price now because they're dependent on the Russians, but they also had no backup when things went wrong, like Texas too, when things went wrong with the weather. So it'll be a long time. Had we developed nuclear, I know people are afraid of nuclear. Had we developed nuclear, it would be easier. I will say this, a lot of people point to certain things, and they say, well, this will help, and I'm not so sure it will, and I'm thinking of electric cars. This is not me trying to slap Elon. Electric cars. As one person said to me, we have brownouts every summer because there's too much demand for electricity. What is going to happen when everyone's plugging in? Because these cars absorb a great deal of electricity. And even if we had the generating capacity to support them, it would be mostly oil and natural gas that generate it. So we'd be shifting the climate problem from the cars to the generating plants. So it's a long time. Another thing I won't live to see. Not that I wouldn't welcome it, but another thing I won't live to see.
Laura?
Yeah, so you mentioned earlier the Biden administration kind of really scaling back, and one of their promises really revolved around domestic oil, and it seems like they're walking back on that promise a little to address supply and the price of oil and kind of handing out licenses and things like that domestically. Do you see that as a bit too late, like too little too late to do that? And thinking on the grand, kind of on a larger scale, will that actually help address these issues that folks are facing?
This is about the Biden administration is beginning to walk back its utter hostility to fossil fuels in order to help the situation. And it can help, but it takes time. And one of the things that has happened in the last year, because the federal government doesn't drill, the federal government doesn't produce any energy. If we could harness the hot air, it might help, but we can't. It's the drillers and the oil companies that do this, and they have been told all year that they're evil people and their profits are something that might get confiscated in one way or another. So they're not so eager to help. It's not spite. They just say, I'm not going to spend millions to drill and ship the oil and then have you take it away from me when the crisis ends. And that is the feeling among oil executives. And unfortunately, that is a product of the rhetoric we've been hearing for about a year and a half. So it's going to be hard. Releasing oil from the strategic reserve might ease prices for a week. We don't have enough in the strategic reserve to support our consumption of oil for up to a month. So that was for military purposes. That's what it's there for. So it's not too little. It's not too little, too late. They're also living with the history of what they had done. Because even if they would ease things entirely, the industry would be reluctant to respond. Not, as I say, not out of spite. These people don't spite anybody. They just want to make money, and they want to keep it.
I think Marta had a question.
I think a barometer that a lot of the general public uses is the housing market to gauge how well or how poorly the economy is doing. And I know over the past probably year, even more, we've seen incredibly high home prices, incredibly high demand. And so I was just hoping that you could expand on what we can expect moving forward given these ongoing factors of inflation, rising rates, and as well as just ongoing supply chain issues too, still contributing to the inventory problems. So I'd just love to hear more about kind of the real estate sector specifically.
Yeah, the question is about real estate and what the inflation and the rising rates are likely to do and supply chain problems. There are a lot of cross currents in the real estate market. The inflation itself tends to raise real estate prices because it's a place to hide in inflation, especially when bonds are yielding less than the inflation and the stock market looks like a dicey prospect. So that will help prices rise. But we're also raising rates. Now, right now, if you can afford it, if you have the cash flow, I'll give you an example. Well, not even a year ago, last summer, you could get a jumbo mortgage on a large house for less than 3%. Now, the inflation was running at, then it was running at about 7%. So the example I gave you before is the bank was actually paying you in real terms to borrow the money and live in the house. That number has gone up to about 5.5% today for a jumbo mortgage. And I'm saying a jumbo mortgage because almost all mortgages these days are jumbo mortgages. It's gone up to 5.5%. It still is an incentive if you can afford the cash flow to borrow and buy, especially since the price will come under upward pressure. But as the Fed raises these, fewer and fewer people have the cash flow to support that mortgage, so you will have a shortfall in housing demand, even at the very high end of the market, unless they can pay cash. And when mortgage rates get above 8%, then you won't have this special incentive of having the real value in your favor. So I don't think housing prices I think the housing market's going to suffer. The demand's going to drop and prices will rise less rapidly than they have. And they've been beating inflation for the last couple of years. That demand will drop. I don't think we will have a crash in housing prices the way we did in 2008, 2009 for two reasons. One is the financial situation is not as fragile as it was in 2008, 2009. And two, inflation was very low in 2008, 2009. So when prices fell 10% in housing, it was a 10% loss. With inflation now, that would be an 18.5% loss if your price fell because of the inflation, there is this inducement to buy land. So I don't think prices are going to suffer. I'm not saying they won't falter or level off, but I don't think prices are going to suffer the way they did. I don't think we're going to have a crash the way we did because finances are in much better shape. But am I upbeat on housing activity? No. This is very depressing.
I know.
Isn't it?
I know. Does anyone else have, we have a question? Okay.
Are there any questions online? Any questions from the virtual audience?
Well, I think this concludes today's edition of Best Ed. Thank you, Milton, for fielding
you.
all of our questions, and thank you for everybody who tuned in and joined us today.
Thank you.
Thank you.